we're at now, and this is again where it gets really interesting. So if you're a mortgage holder, and in fact, CBA, they have a household spending data that they release regularly. And again, I think the latest release from them really captures what's happening. If you are a renter or a mortgage holder, you are finding it tough because interest rates are high. So their spending last month down. If you then go to those people who don't have mortgages, their spending up. If you then go to things like aeroplane travel, if you try and book a ticket to go to Europe or America and try and want to fly first class or business class, you will find it really expensive. You want to fly economy, it's actually quite cheap. It's not a problem. So what's that tell me? Rich people are having a lovely time. The Australian share market is at all-time highs. I think we're actually just probably yesterday hit a new all-time high. The US market is high, gold's high. Anything you want to invest in, the price of real estate, up. You put money in a bank, term deposit, up. If you're a self-funded retiree, life could not be better. So those people having a lovely time. They're out there spending, and in fact, they're spending more. The RBA, as I've mentioned, is trying to slow the economy. So they've only got one lever, and that's interest rates. So they are trying to put interest rates up or hold interest rates to try and slow the economy. And in many respects, we've actually got another part of the economy that's actually in some respects celebrating high interest rates because I just get more money for my term deposits. This is fantastic. It's a real problem. I'll give you another one. Ingham's. We had a headline as we were promoting this little session about chicken consumption. So Ingham's, as you're probably aware, is the largest supplier of chicken in this country. Now, chicken is an interesting meat because it's the major staple of fast food. Now, you go and talk to Ingham's and they'll tell you that sales are sort of okay. But what we have noticed, fast food sales have dropped away significantly. Supermarket sales have actually gone up. So what they're saying is that people are giving up on their fast food and actually going to a supermarket to buy their food. We've also seen general meat consumption go down. Now, again, that's not because people are turning to a more healthy diet. This is happening over the last few months. This is about people who, mortgage holders, renters, finding it tougher. They're pulling in their belts. But it's really not coming through in the numbers because we've got, as I say, this other section of the economy which is piling away, having a lovely time.
So Nick, can I just pause on that because the chicken consumption piece, which obviously anyone who's seen the campaign or campaign graphics, was something that I found just really extraordinary when Nick and I were just first brainstorming this session. And Nick, I wanted to just go into that a little more because you've mentioned that chicken being the most commonly utilized meat in fast food. Why specifically, if you can just go into the detail of why specifically that takeaway piece going down is so important in terms of people's lifestyle and then what that means about broader consumption patterns being a truer indication of where the market's at?
Yeah, so for better or for worse, if we think about McDonald's, KFC, it's mostly, there's a big skew which is well known towards people on a sort of a lower socioeconomic grouping. It's people on lesser incomes actually spend a disproportionate amount of their income on fast food. We're talking here a lot of single people. We're talking people on lower incomes. That's where they've been historically spending more of their money than a self-funded retiree who you often won't find in McDonald's. So that's the skew. Those people are the ones who are finding it tough. Those people who are on the lower incomes, they're the ones who are, cutting back on shopping at McDonald's. That's the blunt take of it. I'll give you another one. Nick Scarlett Furniture reported yesterday. Now, Nick Scali Furniture have reported that their sales, so Nick Scali's sort of slightly upmarket. It's not the most expensive place in the world to buy your furniture, but it's certainly more expensive than IKEA. Their sales up, their profit was down, their costs are going up. Their cost for freight has gone up big time. They're having to ship. They can't ship through the Panama Canal anymore. They have to ship all the way around the bottom of Africa. And their staffing costs have gone through the roof. So the next step, everyone expecting Nick Scali is going to put up the cost of their furniture. It's inflation. Exactly the thing that the RBA is trying to close down. So what will happen, Nick Scali will put the prices up. They'll still sell. Their share price is actually, a lot of people are saying it's a buy because the underlying demand is good. So they're just going to restore their profit margin. It's a double whammy as far as the RBA is concerned. Their bastards are buying more furniture and they're paying higher prices for it. It's exactly the thing they're trying to stop. It's not good.
And I think you raise a really interesting point, because I've never really contemplated an economy of such a wealth disparity.
Yeah.
And it feels like we're dealing with two very distinct beasts, which are in direct conflict. Would that be a correct
Yeah,
statement?
no, it's exactly right.
And
it's becoming more and more apparent, and it's about the fact that we're getting this skew of baby boomers now who make up, a large chunk of the population, and a lot of these baby boomers are actually smoking cigars, no mortgage, and life's pretty good. And so we're getting, the tax burden is falling onto a smaller and smaller group of people, and it's a real socio-economic problem which we need to address. That's a whole another session.
yeah, we'll solve that in another session. Stephen, I'd love to hear your thoughts. I'd like to hear your thoughts twofold. Firstly, in terms of what you're seeing in comparison to this ABS data. And then secondly, what divide, or if any divide, you're seeing in terms of this wealth disparity that we've been unpacking?
Yeah. So I think, just to concur on what Nick's saying, and I like to put things into quite simple terms. So this time kind of last year, I would have been lucky maybe to get one phone call every 2 or 3 months for someone that is struggling with their mortgages or needs help kind of with budgeting expenses, right? Probably getting 2 of those phone calls a week at least at the moment, right? What I'll probably say where I'm seeing it more prevalent is probably not the person that owns one property, the people that own the 2, 3, 4 properties, basically in that range. So at a fairly good, existing client of mine holds 5 properties. One of those being the owner-occupied property. Probably looking back now, overextended himself to get into that owner-occupied. And with all the commentary that's happening in Victoria with the land tax, stuff like that, he's given me a call to basically say, Steve, where do you see things, right? And, for me, I am very European by nature. And what I mean by that is I'm a big believer on basically holding assets, paying down debt, acquiring them, and getting to a point in life where you can realise the cash flow on those properties, right? So my advice to basically that person is, if you can financially manage it, I'd suggest that basically you keep the properties, right? Because obviously 3 of the investment properties are in Victoria, right? And we know that it's if he goes to sell them right now, he's probably not going to maximise what those prices are going to be. However, if he's finding that he's not able to keep up the loan commitments, then obviously you're going to have to look at a debt reduction strategy, right? Those conversations that I'm saying, we're probably having at least a couple of those a week at the moment. In terms of the people that don't have many liabilities at all, I completely concur with Nick. Those people are living really, really well at the moment. So I was talking to a couple of first home buyers. They're probably one of these type of people that they've had the deposit for basically 20 years. That they're living in the good apartment in basically South Yarra, right? But they're between 45 to 50 and they're looking at now, what's my retirement strategy going to be, right? And so, those, when you look at the living expenses for those people, you're seeing that they're spending thousands of dollars basically on dining out. It's funny, Nick, when I was looking at their bank statements, yes, recently going to Europe, basically business class, right? Saw what those flight tickets actually were on that file, and they were exorbitantly basically expensive. And the conversation very much around those people was, Steve, when we see interest rates, what do you think we're going to have to sacrifice here because we still want to maintain this lifestyle, right? And when I'm discussing, what the potential loan repayment's going to be, on $1 million, and, bearing in mind they're 45 to 50, you're not going to be recommending ideally at a 30-year loan term because you want them to obviously have the property paid off prior to retirement, right? They're looking at that figure and saying, gee, if we do this, Steve, we're really going to have to sacrifice some of what we're doing. So yeah, I think there's a pretty a big difference at the moment between the people that have the liabilities and the people that don't have the liabilities right now, Sasha.
And that's actually an interesting point as well, because I would expect, and by all means, both of you challenges, I would expect that those people who are used to a more affluent lifestyle are getting a bit of a rude shock about maintaining that. So whether or not, that in itself will help curb spending, because, as we're talking about, whilst they may be in a position where they are used to having quite a lot of disposable income, what that's then buying is becoming far more restricted. So, Nick, do you think that would be a natural dampening on or slowing of spends, even for a more affluent group, because the cost of everything is going up so much? Or do you think they're fairly price immune?
Yeah, I mean, I sort of take the even, more macro approach here. The RBA always wins. They do not lose.
Right.
So the economy will slow because they will keep interest rates up, and they'll potentially even put them up higher until the economy slows. And that's the game. They're quite open about it. It's not a secret. It's a fact. So the only question is when it starts to slow a bit more. So everybody was thinking that it was going to slow sort of now, and we'd actually be enjoying our first interest rate cuts later this year. I think most people are now saying, it's probably now pushed out into next year. Looking at these charts, I go, it's definitely pushed out into next year. There's no way they're going to be cutting interest rates this year. So when will they? February, March, April, I don't know. But it'll be when the economy actually starts to slow.
And Nick, just to ask you a question on that, when we do have the first rate cut, do you think that immediately makes property prices go up, or what's your thoughts on that, Nick?
No, I don't, because, and this is where we're starting to see it overseas. So we're seeing Canada, the UK, New Zealand. The economy, unfortunately, often doesn't just slow, it actually starts to really slow. And we're seeing some quite significant, 0.5% cuts in places like New Zealand, because they're actually, when it starts to go over and slow, it starts going too quickly. So it wouldn't surprise me that when it does actually topple, it will, and it will slow, that we'll actually see, interest rate cuts coming close together. And, a little bit like when we're in the peak of interest rates going up, when they're really trying to slow the economy, we'll tend to see that when we on the backside. But at the moment, unlike the rest of the world, Australia is still flying along.
So I guess my take on that, Nick, is, and look, I could be wrong. I think you're a lot in these areas. You're a lot smarter than I am, but I think that once people get access to basically cheaper monies very quickly, when that happens, I think we'll see an upward trajectory in basically property prices. That's just my own kind of personal opinion. So I'm seeing a lot of people basically wait on the sidelines at the moment. They want to do something, but they're waiting for that first rate cut. And then I think people are going to heavily compete for those properties. And, let's say, we have 2-3 months where we see basically consecutive rate cuts. That's probably going to increase borrowing capacity by 5 to 8%. So my thoughts are what becomes 700,000 becomes 750 pretty quickly.
There's a lot of money still out there.